When you think about it, insurance just makes sense, right? You pay a small fee, a premium, for a certain level of coverage over a specific period of time, and sometimes you have to file a claim. Well, hold on to that thought because options trading works on the exact same logic, except you get to be the one selling the policy.
And really, that's the big idea we're going to unpack here. At their core, options are just insurance contracts for stocks. And once you see it this way, all that confusing jargon, it just clicks into place. You stop thinking like a trader and start thinking like an underwriter.
So let's start there. Let's translate the language. We're going to map the terms you already know from insurance directly onto the world of options. And you'll see it's pretty much a perfect one-to-one fit.
Check this out. See how cleanly this all lines up? You know that fee you pay for your car insurance? In options, that's the premium. The dollar amount your policy covers you for, that's the strike price. How long the policy lasts? Well, that's the expiration date. And that moment when a claim gets filed and the insurance company has to pay up, in the options world, we call that assignment. It's the moment the insurer has to make good on their promise.
Now, as the insurer, the option seller, there are two super popular policies you can offer. With a cash-secured put, you're essentially selling insurance against the stock's price dropping too low. And with a covered call, you're selling insurance against the price spiking too high. Let's break down each one.
All right, let's get into our first case study. We'll start with the cash-secured put. This is your way of acting as the insurance company for someone who's worried about their stock losing value. Think of it exactly like collision insurance for a car. If there's a big wreck, the insurance company has to pay. Well, with a cash-secured put, you sell the policy and you set aside cash, just in case. If the stock crashes below that agreed-upon price, the strike price, then a claim is made. You get assigned, and you have to use your cash reserve to buy 100 shares at that strike price, even if the market price is way lower. But if the stock stays above that price, the policy just expires and you get to keep the entire premium. Simple as that. So let's look at the numbers for this policy. Your maximum profit, your best case scenario, it's the premium. That's the fee you get paid and you keep it no matter what happens. Your break-even point is just the strike price minus the premium you took in. And the capital you need to have on hand, your insurance reserve, so to speak, is the strike price multiplied by 100, since one options contract always represents 100 shares of the stock. Let's make this really concrete. Let's say you sell a put on stock XYZ with a $50 strike price, and you collect a $2 premium. That's $200 in your pocket right away. Now, if the stock does drop and gets assigned to you at $50, that premium you collected effectively lowers your cost. $50 minus that $2 premium means your real break-even price is actually $48 per share. And honestly, this is the most brilliant way to think about it. A cash-secured put is just like setting a limit order to buy a stock that you already like, but someone literally pays you a fee just for setting it. If the price drops to your target, great, you buy it at a discount. If it doesn't, oh well, you just keep the fee. You're getting paid to be a patient, disciplined buyer. Okay, let's switch gears. What if you already own the stock? Now we can talk about selling a different kind of policy, upside cap insurance. The official name for this is writing a covered call. This is kind of like having an agreed value insurance policy on a collectible, maybe a piece of art that you own. You already have the asset, in this case, 100 shares of a stock. You then sell a call option on it and collect a premium. In exchange for that cash, you agree that if the stock price rises above your strike price, the person who bought the policy has the right to buy your shares from you at that pre-agreed price. So the math here really shows the trade-off, right? Your maximum profit is now capped. It's basically the difference between the strike price and what you originally paid for the stock plus the premium you collected. That premium also gives you a nice little downside buffer, kind of like a small cushion against losses. But the trade-off is huge. If that stock just skyrockets to the moon, you've already agreed to sell it, and you're going to miss out on those massive gains. That's the coverage you're selling, and the premium is your payment for that promise. For example, let's say you bought 100 shares at $46. You then sell a covered call with a $50 strike and collect $1.50 in premium. If the stock shoots up past $50, say to $52, your shares are going to get called away at $50, but you also get to keep that $1.50 premium. So your effective selling price is really $51.50 per share. You made a nice profit, but you capped your upside. And here it is, the perfect analogy. Selling a covered call is just like a real estate developer paying you a non-refundable fee today to lock in the right to buy your house at a fixed price 6 months from now. You get cash in your hand right now for agreeing to a potential sale down the road. So we've seen how these policies work. But being an insurer is not about collecting free money. Not at all.
It's about managing obligations. And to do that, you need discipline and a very clear understanding of the risks involved.
Look, any good underwriter has a checklist. First, only sell puts at a strike price where you'd be genuinely happy to own the stock. For calls, pick a strike where you'd be happy to sell it. Always know your numbers, your break-even, your max profit, and your potential loss. You have to respect big events like earnings reports that can cause wild price swings, and this is crucial. Always keep your puts cash secured and your calls fully covered. Being a disciplined underwriter is the name of the game.
So, let's just boil it all down to this final, simple comparison. A cash-secured put acts like a paid limit order to buy a stock you want, but at a discount. And a covered call acts like a paid listing agreement to sell a stock you already own, but at a guaranteed profit. Both of them generate income by taking on a very specific and calculated obligation.
So the real question isn't just about trading, is it? It's about insurance. By thinking like an underwriter, you can better understand the risk you're taking on and the premium you deserve for it. So now that you understand the policies, what are you willing to underwrite?